Good evening. This is Professor Mayer, and this is our first chat session for our Intermediate Accounting, the ACT 5008. We are going to, in this course, be talking about some very specific chapters in the Intermediate Accounting book, which is the Spiceland book. The first chapter that we're going to be talking about is related to pensions. This is actually an interesting topic, and while the pensions can be a somewhat of a complicating process, hopefully the way we cover it and the material that you see should be actually very good in terms of helping you understand what it is that we're attempting. So let me just cover a couple of things that I think are going to be very important as we are moving forward related to this chapter as well as this course. Is what you see in the Blackboard is that you have access to three assignments you have access to. There is a extra credit quiz, and you take it, you don't take it, whatever you do, make sure you do it by Wednesday. The reason I have this quiz set up is that what I want you to do is to sort of get a feel for where these assignments are in the Connect area. I also need to validate the fact that you're actually part of the course, and setting up these quizzes tend to be a very efficient means of doing that. So to do the quiz, I think the quiz due date is Wednesday, and if you can do that, that would be absolutely fantastic. Hopefully you have your Connect Accounting by then. We'll see how that goes. What you'll see also is a practice assignment and the actual graded homework assignment. Now, the way I do these assignments is that the practice assignments are taken directly out of the book. And actually, I got a call today from a student that was asking, well, she already has the KESO book. Is it necessary that she gets the Spiceland? The answer is as long as you have the Connect for the Spiceland for my course, you should be fine from the perspective that the assignments that you see, they're fully online, so they're not going to refer you to the book. But if you do have the book, you actually will see the assignments there. The assignments are set up in such a way that the practice, and you can practice all you want to, and hopefully you'll get a sense of using the Connect, where the Connect becomes very valuable in terms of helping you understand how these assignments actually work and the feedback that you're going to get. Once you've done the practice, what you'll find is that the assignments, the graded assignments, are actually the same problems. The difference being is that the numbers are actually different. So in the assignments, you've got, I think there's 5 specific problems coming from the book. These are the same as the practice problems. So the idea is that if you do the practice problems first, is you're going to be well prepared for doing the assignments. Neither the practice nor the assignments are timed, so my suggestion is that you get into these right away and you begin to do your work. Again, with the assignment is you don't want to submit it till you're actually done. But with practice, again, if you start working with the practice and sort of get a sense of what you can do with Connect, I think you're going to find that the process actually is a very good process in terms of helping you understand what's taking place. Okay, so that's the information that I want to cover related to the assignments. We are going to have specific assignments related to each of the chapter material. Keep in mind that our next discussion, our next chat session is going to be next week, and the problem is that in 2 weeks we actually have Memorial Day, so the chat sessions are not exactly evened out throughout the course, but you'll see in the syllabus is that there's a specific timetable for when all of these assignments actually are required to be turned in. Okay. Oh, and the other thing is related to the assignments. There's a specific due date for the assignment. Keep in mind that that due date is required, and the idea is that if you do submit it late, you are able to submit it late, but that you're going to get a deduction in your grade based upon the number of days that you actually submit it late. So just keep that in mind and try to do everything you can to submit the assignments on time. So let's talk in this chapter specifically related to pensions. This is, as I had mentioned before, is a very interesting topic and appropriate. I guess it's more appropriate the closer you get to retirement, but it certainly is something that should be on everybody's mind, because guess what? Everybody's going to grow old. Everybody is at some point in time going to retire, hopefully. What you want to have is you want to have the funds available so that you can enjoy that part of your life. Now, whether or not this is a defined benefit or a defined contribution, the process essentially works like this. Is you are working for an employer, and through the employer there are contributions. If you have a defined contribution, such as a 401k, 403b, this is money that's taken out of your paycheck, and this is what we call a pre-tax deduction. That money is then submitted to a pension plan administrator. So the pension plan administrator is then responsible for making the payments to you. And these benefit payments to you come at a point when you actually retire. The key point is the fact that the employer does not hold this money. Whether you have a defined contribution or a defined benefit plan, all of these contributions go to a plan administrator. The plan administrator could be TIAA-CREF, or it could be Fidelity, or it could be a multitude of other organizations that actually manage pension plans. But the idea is that the employer has a specific responsibility to make these contributions to the pension plan administrator, and then you as an employee are then receiving the benefits from the pension plan administrator. Let's talk about the difference between the two primary plans, the primary plan of a defined contribution plan and a defined benefit plan. A defined contribution plan is, most organizations have this. It's a fairly simple process in the sense that, again, we're talking about something like a 401k or a 403b, and the idea is that the employee is making pre-tax contributions to the plan, and these, again, the money that you're contributing doesn't stay with the employer but goes to the plan administrator. It's very possible that the employer is also contributing to this plan. The amount of contribution depends greatly upon the actual organization, but the idea is that the money is then going to the plan administrator, and then when you retire, you have a pool of money that then you're going to be able to draw from after you retire. That's your money, and the idea is, in a defined contribution plan, is if you contribute the maximum, which this year, if you're less than 50, is I think $18,000, you get an extra bonus of $6,000 if you're greater than 50, but you can contribute the maximum or you can contribute nothing. And the point is that if you contribute nothing, the employer has no responsibility over that. The problem is that when you retire, you really have no money. Benefits to the employer in a defined contribution plan is that it's fairly simple in terms of the administration. You certainly want to make sure that the money goes to the plan administrator. You have responsibilities in terms of training and teaching and providing guidance for your employees, but ultimately, as long as you can get that money to the plan administrator, your responsibility ends there. If the employee ends up at retirement where he or she made bad business decisions, bad investment decisions, or even failed to contribute to the plan, you may feel sorry for the employee, but it's not really your responsibility. So most organizations have really moved towards a defined contribution plan simply because of the fact that the management of this is actually much easier. Now, what this chapter is about and what we are really focusing on is what's called a defined benefit plan. This is where the organization has a significant responsibility to the employee in the process of the retirement planning for this individual. The idea is that in a defined benefit plan is the employer is defining a specific benefit at retirement to this employee, and this benefit is based upon years of service, based upon a factor that we'll talk about, as well as the salary at retirement. Now the problem from a management perspective is we're basically creating a liability that extends potentially for, you might say, for 100 years. If someone starts their employment at an organization and stays in that organization till he or she retires and then lives for another 20 or 30 years after retirement, that's a long time for the organization to maintain a responsibility and a liability related to this individual, which is why many organizations are actually moving away from these defined benefit plans because of the complexity, the expense of these, and the unknown nature related to all of the issues that are going to impact the actual liability to the employer. You notice here at the bottom it talks about the actuarial estimates of the employee's contribution, what we consider as mortality rate, employee turnover, interest rates, earning rates, early retirement frequency. There's a lot of variables that come into play when the organization is actually defining what their liability is specifically related to these pension plans. And again, because of the complexity, because of the management structure of these pension plans, because of the liability that extends for many, many years, many organizations are moving away from these defined benefit plans and simply asking employees to contribute in some sort of defined contribution plan. From the employee's perspective, a defined contribution plan has the benefit in the sense that what takes place in most cases today is that when you take a job, you're probably not going to spend your whole career in that job. You're going to be moving around, you're going to be moving around every couple of years. It's very possible that over a career lifetime, you may have had 10 or 12, maybe 15 different jobs. That's not at all unusual. In a defined benefit plan, it doesn't necessarily, you're not really maximizing the value. But in a defined contribution plan where you're rolling over the money from one employer to another, is you can actually do very well related to this. Again, planning is the key. But what we're talking about in this class is really related to the defined benefit plan. So in a defined benefit plan, one of the things that we need to understand is some very specific definitions. First definition that we talk about here is vesting. Vesting essentially is the point in time when the employer has a liability associated with a specific employee. And let's kind of think about it this way. Generally speaking, vesting occurs after you worked for 5 years. So once you've worked for 5 years, from the employer's perspective, they have a liability related to you. You have a guarantee related to a specific component of your pension. We talked about this in the sense that the pension is based upon a couple of factors, one of which is years of service, the other is the salary, and the final piece is some sort of factor that the employer uses. Now, The employers may use a factor of 1%, 1.5%, 2%, maybe more than 2%. 2% I haven't more than 2% I haven't seen, but it's very possible that that's the case in some situations. But the idea is that in this situation, just kind of think about this, is vesting. Is, let's say there's a defined benefit plan and the employer has set up a scenario where that they're paying 2% times the number of years worked times your salary. Now, let's say the person worked 5 years. Let's say he's 25 years old at the end of this 5 years. So he's vested. So he has 5 years. Let's say that factor is 2%. So 5 years times 2% is 10% of his salary. And let's say at the time he quit he made $50,000 a year. So basically what the organization has is a responsibility to this person when he retires, not right now, but when he retires at 65, to pay him basically $5,000 a year until he passes away. Now just kind of think about the logistics related to this, in the sense that now the gentleman is 25 years old. He's not going to retire for 40 years. And let's say he lives for another 30 years after retirement. So we're talking about 70 years of responsibility from the perspective of the employer, specifically related to this employee that worked for an organization from the time he was 20 years old and he quit at 25 years. That's the difficulty in terms of this liability related to the organization. Okay, but again, vesting is when there is a liability, a legal liability related to this employee based upon the number of years worked, and usually vesting occurs at 5 years. The accumulated benefit obligation, which is the centerpiece here, is, or we call this the ABO, is essentially important because what this defines is what the salary is at retirement if the employee were to quit today. So the accumulated benefit obligation is years of service times the factor times the current salary. So again, if the person is vested, he quits or she quits, well, that is their vested amount. So again, it's say 5 years times 2%, which is 10%. Say they're making $50,000 a year. Well, when they retire 40 years from now, that money is what they're going to expect to get. The final definition, you notice that it's called the projected benefit obligation. The projected benefit obligation is the same as the accumulated benefit obligation with one exception. What we're using here is the salary at retirement. So the projected benefit obligation is the years of service worked times the factor, and for our purposes, let's call that factor 2%, times the expected salary at retirement. Now that's very important when we consider the expected salary at retirement, because what that does is that defines the pool of money that the organization needs 40 years from now when that person retires, so that the spend down of that money essentially is to the point where the expected death of the employee. And we'll go through this in more detail later on. But the projected benefit obligation, or the PBO, essentially is defining, again, the years of service to date times the factor, whatever the employer has, times the expected salary at retirement. What does all this mean? Well, what this means is that what we have on our income statement for the employer is what we call the pension expense. Now, the pension expense essentially is the incremental difference between last year and this year. The two things that I want to focus on, we'll focus on all of these, but I want to focus specifically on what we call the service costs and the interest on the liability. Well, the service costs comes from the fact that the employee now has one more year of service. So let's go back to our gentleman that vested at 25, and let's say he doesn't quit. Well, last year he was 25, he has 5 years of service, so it's 5 times 2% times, and again, we're going to use the PBO, the projected benefit obligation. Let's say we're expecting him at retirement, he's going to make $100,000. Number of years worked times the factor, we're going to call that 2%, times the salary at retirement. So we're going to call that $100,000. So what we're saying is that at retirement, that gentleman is going to make, based upon years of service to date, 5 years, which is last year, 5 years, times 2%, 10%, times the $100,000, which is $10,000 a year. Now that $10,000 a year is, kind of think about that as an annuity. That's going to be paid until he passes, but the actuarial say that, you know what, he's only going to live 20 years past retirement. The question becomes is, if it's $10,000 a year over a 20-year period based upon a discount rate, how much do we need at retirement at 40 years from now to cover, from an annuity perspective, using a specific discount rate until this person passes away? That's the amount of money that we need. Incrementally, that's going to change year from year. You notice the pool of money doesn't change, but because we're still using the expected salary at retirement, and the actuarials are still counting on this gentleman to only live 20 years past retirement, so that bucket of money doesn't change, except for the fact that from last year to this year, he now has 6 years of service. That's what we call the service cost. The service cost is the incremental increase in the years of service as it impacts the retirement. So last year is 5 years, 5 times 2% times the salary at retirement. Now it's 6 years. 6 years times 2%, which is now 12%, times the salary at retirement, so he's going to get a little bit more. So the bucket of money that we need at retirement increases because he has another year of service under his belt. Now you notice the other item is the interest on the liability. We understand that we need to have this pool of money when this gentleman reaches 65 years old to pay until he passes away. But to get to that money, we do a present value of that pool of money. Well, last year it was 40 years until he retires, but this year it's now 39 years. So incrementally, we have one less year of service, or one less year to accumulate the money so that we have the money at retirement. So those two things, key points, sometimes hard to sort of differentiate. You don't have to calculate these. Actually, I think you do a little calculation in the problems, but that's really what we're talking about. Is we're talking about, again, service costs is incrementally, this person now has one more year of service, and the interest is we now have one less year to accumulate the funds. Now, keep in mind that the money that has been set aside for the retirement of our employees is in the plan administrator. One of the responsibilities of the plan administrator is to actually accumulate money so that they can actually pay the retirement benefits. So they're accumulating the money and they're investing the money. So any gains that they make on this money is going to decrease the pension expense. If they have losses, it's going to increase the pension expense, but there's also other issues that we want to think about here. And you notice that we use the term actual return on plan assets. Well, we're going to talk about the distinction between actual return and expected return, but for right now, just kind of think about it in the sense that any returns that the plan administrator has related to plan assets is going to reduce the pension expense. We have these other two items here, which is the amortization of prior service costs. Generally, this is going to increase the pension expense. The prior service cost occurs in most cases when there is a union negotiation, and in this union negotiation, the organization agrees to additional funding that impacts prior service. So as opposed to taking the total amount and adding it to pension expense, we actually amortize this. So we'll talk about this a little bit later on. And then what we talk about is gains and losses. We'll defer this to a little bit later in the discussion, but the idea with gains and losses is what we're attempting to do is we're attempting to smooth some fairly significant gains and losses that may occur in the life of the pension. Because again, we're talking a liability that extends for 100 years or even more than that, significant gains and losses that are temporary. We don't want these to essentially distort the overall goal of the pension. Okay, I want to take a look at this slide and give you sort of an idea of, again, what we're looking at is we're looking at the projected benefit obligation. So you notice here, and in this case, the problem shows that it's actually 1.5% times 10 years. And the 10 years of service, essentially what this person did is they started in 2005. It's now 2014. So they have 10 years of service. They are expecting to make at retirement the projected benefit obligation of $60,000 a year. And then at retirement, the expectation is that they'll retire for 20 years. The actuarial is basically saying, you know what, after 20 years, very high probability that they will no longer be around. Okay, so we're talking the 20-year retirement stops the retirement when the person dies. Okay, so that's the reality. Okay, now here's what we've got so we've got 10 years of service. We have what we call a service period of 30 years. So we have 30 years to accumulate this money. But the idea is that 10 years of service times the factor, in this case it's 1.5%, means that we need basically $688,195 in 20 years, or excuse me, in 30 years, so that we can pay this person until he passes away. So we're looking at a present value. The number of periods is 20. The discount rate is 6%. And this is the annuity at the retirement date, which is $60,000 times the annuity factor of 11.4%. And it's $688,000. So we need $688,000 in 30 years. Now, we discount that based upon an interest rate, and whatever that discount is that is our liability at this point in time, or our liability, or what we call our projected benefit obligation. Next year, what you'll see is that we have one less year to accumulate the money, and in fact the service cost increases it because he now have 11 years of service as compared to 10 years of service. So that's what we see here. The third item is the present value. N is 30, so we are discounting this for a 30-year period. We're still using the discount rate of 6%. And what we're saying is that the PBO, as of 2014, is $119,822. Next year, it's going to be more for two reasons. There's now one less year to accumulate the money, and there is also the fact that he now or she has 11 years of service as compared to 10 years of service. So what we're talking about here, and I'll go through these definitions, make sure that we understand these. Service cost is the actuarial present value of the new benefit earned by employees during the period. Again, we're looking at it from the perspective of from last year to this year. We're looking at our financial statements. So incrementally, the service cost is attributed to the fact that we now have one more year of work experience. So this person is now has 11 years of service as opposed to last year 10 years of service, and that 11 years is included in the calculation. Interest on the liability is the fact that we have one less year to accumulate the money. The actual return on plan assets is the amount of money that the plan administrator has accumulated based upon investing the funds that they've had. Amortization prior service costs, we've talked about this, it's a plan amendment usually occurring with the fact that there is some sort of union negotiation, and the union negotiation was such that it actually affected prior service, and in this prior service is that these prior service costs are then lumped together and then amortized over a specific period of time. We'll talk about the volatility in the sense that if there's significant gains and losses, these significant gains and losses stay in other comprehensive income, and then what we do is we actually amortize the gains and losses over a specific period of time. So let's look at a couple of these things and indicate what these are. Indicate whether these represent increases or decreases, have no effect on the plan. Kind of hard to do one at a time, so let's do each of these individually. Interest cost increases the expense. Amortization of our prior service cost is an increase, and the prior service cost needs to be there, but it's going to be part of other comprehensive income, and then we're basically going to amortize a piece of this, usually over the normal life of the individuals working within the organization. The expected return on plan assets. Now you notice, and I want to make this distinction, we talk about the expected return and the actual return. So in terms of the pension expense, is we reduce the pension expense based upon the expected return on plan assets. So this is a decrease in our pension expense. Plan amendment that increases benefits is made retroactive to prior years. There's going to be no effect here. Again, if it's a prior service cost, this is then moved over to our other comprehensive income and then amortized. An actuarial estimate of the PBO is increased. This has no effect. It may, in fact, be part of our actual gains and losses that we're going to keep in other comprehensive income. So I think that's a sort of a simplistic answer to this. A couple other things, cash contributions. There's no effect to the pension expense, but the cash contributions is going to increase the plan assets because the contribution comes from the organization and goes directly to the plan administrators. Benefits are paid to the retired employees. When benefits are paid, what this does is this decreases the PBO, but also it decreases the PBO because The PBO essentially is a liability. As this liability is paid, we decrease this, and then the plan assets decreases the plan assets because these plan assets, this is where the benefits are paid from. Service cost is the incremental change in the number of years worked for the employee. This is going to increase. The excess of the actual return on plan assets over the expected. There's no effect on the expenses, but the excess, the difference between the actual and the expected return, is going to be held in our other comprehensive income. Amortization of the net loss is going to increase. Amortization of the net gain is going to decrease. So let's look at a problem here. And we'll get through a couple of these problems. What I'm hoping to do is, given the fact that next week is before the actual assignment is done, is that we'll actually spend a few minutes talking about some additional pension issues. The following relates to Voltaire Company's defined benefit plan. So what we have is we have pension assets at fair value on January 1st, $600 million. The expected return on plan assets of $60 million. The actual return of $48 million. So you notice that there is a difference between the expected return and the actual return. Contribution to the pension plan, $100 million. Amortization of the net loss, $10 million. Pension paid, $11 million, and the pension expense is $72 million. Determine the amount of the pension plan assets fair value at December 31st. So let's kind of work through this. Pension assets at the beginning of the year is $600 million. The contributions was $100 million. The actual return was $48 million, and the benefits paid to retirees was $11 million. So what this is saying is at the end of the year, there were $737 million. So you notice that the actual return is impacting the plan assets. But what we had just mentioned, and we'll have examples of this, is the expected return is the expense, is a reduction in the expense, and the difference between the expected return and the actual return is going to remain in our other comprehensive income. Pension information for Millington Enterprises include the following. So I have a discount rate of 10%, the projected benefit obligation on January 1st of $360 million, projected benefit obligation December 31st, $465 million, the accumulated benefit obligation January 1st, $300 million, accumulated benefit obligation December 31st, $415, cash contributions to the pension fund, $150,000, and benefits paid to the retirees December 31st. Assuming no changes in the actuarial assumptions and estimates, determine the service cost component of the pension expense for the year ending December 31st. So let's walk through this, and we want to kind of think about this from a couple of different perspectives. Let's just kind of look through what we're trying to determine. Okay, so the beginning PBO, and again, the PBO is the amount of the liability. It's a liability that's actually not on our balance sheet, and we'll explain this in a little bit, but in fact it is a liability. Is we have the beginning of $360,000. What we're attempting to calculate is our service cost. The interest cost is 10% of the $360 million, which is $36 million. Benefits paid is $54 million, and the ending PBO is $465. what we're seeing here through, we'll rearrange the numbers, is that the service cost is $123 million. Now, one of the things to keep in mind is that you do have information here related to the accumulated benefit obligation. The accumulated benefit obligation is basically irrelevant to our calculation. The accumulated benefit obligation is not at all involved in any of our calculations. When we start doing worksheets, it's not involved there. So this, you might call this the red herring number within this calculation. But a couple things to keep in mind is that the discount rate to calculate our interest cost is the discount rate times the beginning balance of our projected benefit obligation. So in this case, the interest cost or the discount rate is 10%, and the beginning balance of our projected benefit obligation is $360,000. Therefore, that is $36,000. Benefits paid is going to decrease the PBO because once you've paid the benefit, you no longer have that liability. Let's go through another problem here. What we're looking for is assumed cash contributions are made at the end of the year. What was the amount of these contributions? So we have a discount rate. We have the expected return on plan assets of 10%. The expected return on plan assets is going to be based upon the beginning balance of our plan assets. The actual return is, again, based upon the beginning balance of our plan assets. The difference is going to go to other comprehensive income between the expected and the actual. And what we have here is the projected benefit obligation January 1st, the plan assets January 1st, plan assets December 31st, benefits paid to the retirees December 31st. So what we're attempting to do is to determine the cash contribution. The reason we're interested in, or the cash contribution is going to increase the plan assets. So let's go through this. So notice the piece here that in this calculation is we have the beginning plan assets, which is $700,000, and the actual return is impacting the plan assets. So the actual return is 11%. This is multiplied by the beginning balance of the plan assets. The cash contributions is also going to increase the plan assets, but that's the number that we don't know. And then any benefits paid to the retirees is decreasing our plan assets. And then what we do have is we have the number there of the plan assets as of December 31st of $750,000. So we rearrange the numbers, and what we find out is that the cash contribution is $39,000. Components of the pension expense. Pension data for Sterling Properties includes the following. We have service costs, the $112 million, projected benefit January 1st, 2016, $850. Plan assets fair value $900,000. Prior service costs in other comprehensive income and of $80,000. 8 of this is amortized. The net loss is part of the other comprehensive income. We amortized $1 of this. Interest expense, interest rate is 6%. Expected return 10%. Actual return 11%. Determine the pension expense for the year. So let's just kind of walk through this. So we know the service cost is given. It's $112,000. The interest cost is the interest cost of 6%. That's the discount rate that's being used. And this is 6% of the projected benefit obligation, which is $850,000. The return on plan assets is, you notice that the actual return on plan assets is, actually we're looking here at the expected return on plan assets is $90,000. We have the amortization of the prior service cost, and the amortization of the net loss. That's $8 and $1 respectively, and thus the pension expense is $82. There's a couple of things that I want to really focus on when we use the pension worksheet. You notice on the right side is that we have a memo record. Well, the memo record essentially has the projected benefit obligation, and to think about the projected benefit obligation as a liability, although the liability is not embedded in our balance sheet. And then we have plan assets. Plan assets are assets, but these plan assets are not on our balance sheet. They're actually held with a plan administrator. However, we do have what we call a pension asset liability. So what we do put on our balance sheet is the difference between the PBO and the plan assets. So if we have a greater PBO than plan assets, then we are going to be reporting a pension liability on our balance sheet, and vice versa. If a plan assets is greater than a PBO, then we're going to be reporting a pension asset. So you notice that we're going to be accumulating pension expenses, and we have cash, and then these other items, prior service costs and our gains and losses, are staying in our other comprehensive income. And as we go through this, I think you'll get a sense of how these items actually work. So let's go through one problem, and then we'll go through a couple of different problems in our next week's discussion. So what we have here is we have Beatty Company has plan assets of $280 and the projected benefit obligation of the same. This is January 1st. So you notice the PBO and the plan assets is both $280. Therefore, we do not have either a pension asset or a pension liability. Service cost was $27,500. The settlement rate was 10%. Actual and expected return on plan assets was $25,000. Contribution was $20,000. Benefits paid was $17,500. So let's look through this and kind of think about all of these as debits and credits. So a credit obviously is a negative number, debits are positive numbers. So you notice here at the beginning, when we go over at the top here, is we have the projected benefit obligation of $280,000. That's a credit. The plan assets is $280,000. The difference between the 280 and 280 is zero. Therefore, a pension asset ends up beginning the year as a zero. So the zero over here represents the difference between the 280 and the 280 over here. Service cost increases our pension expense and increases our projected benefit obligation. The interest cost of 10%, 10% times the projected benefit obligation, that's $28,000. So the interest cost also increases the projected benefit obligation. The actual return, the amount of money that the pension plan actually made on the assets that they held, was $25,000. So that $25,000 actually decreases the pension expense, but increases the plan assets. So you notice there's an increase in plan assets over here. And then the contributions essentially is a credit to cash, but what we see over here is it increases the plan assets. And then finally, benefits paid is there's a debit to projected benefit obligation, credit to plan assets. So basically what it's doing there is it is decreasing the PBO and decreasing plan assets. So what we see here at the end is we end up with a PBO being greater than the plan assets, and thus we end up with a pension liability. So again, keep in mind that the PBO is a liability, but it's not part of our balance sheet. Plan assets are real assets, but they're not part of our financial statement. But what does become a part of the financial statement is the difference between the PBO and the plan assets, and that is our pension asset or liability. You also notice that we're creating a journal entry here. This journal entry is where we have a debit to pension expense, we have a credit to cash, and then the additional credit is going to increase the liability. So we have a credit to the pension liability. Okay, so I think we've come to the end of the discussion. This is what I think is probably a pretty good introduction to pensions. I would suggest that you begin working on the problems, and then next week we will spend some more time before we get into the next chapter sort of covering some additional topics that I think are very important related to pensions. But overall, I think this becomes a very good introduction in terms of this overall topic area. So I thank you very much for your time. If you have any specific questions, reach out to me. Otherwise, what we will be doing is we will be talking again 1 week from tonight. So everybody have a great evening, and we will talk to you then.